Welcome back to Talk Tickers. Today is Thursday, February 5th, 2026. It is a crisp earnings morning. The coffee is strong, and the tickers are honestly the only thing keeping me warm right now.
It is a very good morning to be staring at a trucking screen, that's for sure.
It really is. Usually when we talk about freight during a downturn, and let's be honest, the last 18 months haven't exactly been a party for the transport sector. It's usually a bit of a sob story.
Oh, yeah. Volumes are down, rates are crushed, everyone is miserable.
Right. But this print from XPO, the market is reacting like they just discovered gold bars in the back of a trailer. It's not just a beat. It feels like a definitive statement on efficiency.
It's behaving like a tech stock, honestly.
It is. And we are going to break down exactly why. To do that, I have our resident margin detective here with me. We're going to look at the central paradox of this quarter.
The big one.
How does a trucking company manage to make significantly more money while moving less freight? Because on paper, that just shouldn't happen.
That is the question. It's the classic self-help quarter. That's the phrase you're going to hear a lot today.
Self-help. Usually that implies a bookstore section with gurus telling you to wake up at 4 a.m., but here it means something else entirely.
Exactly. In this context, self-help means they aren't waiting for the Fed to save them. They aren't waiting for the GDP to spike. If you look at the macro, the freight recession has been long, historically long.
So long.
But XPO was behaving like a growth stock on the bottom line. And the core tension we need to explore today is this idea of capacity. They have a massive amount of empty space.
30% of their doors are empty, right?
Over 30% excess door capacity. And we are going to talk about why having 30% of your real estate just sitting empty, collecting dust, seemingly doing nothing, is actually the company's biggest asset right now.
It sounds completely counterintuitive.
It is, but it's the key to the bull case.
I love a good paradox. It keeps things interesting. But before we get to the empty doors and the future bets, let's ground this in the reality of what just hit the wires. Let's run the ticker tape.
Let's do it.
Okay, headline numbers, hot off the press this morning. Revenue came in at $2.01 billion. The street was modeling roughly $1.95 billion. So that is a clean beat.
Right, and it's up 4.7% year over year.
Which, let's pause there, solid top-line growth in a choppy market is rare right now.
It really is. Most transport names are fighting just to stay flat or, manage the decline. Seeing actual revenue expansion is the first green flag.
Fair point. Then we have adjusted EPS. This is the profit number everyone cares about, landing at 88 cents. Consensus was sitting at 76 cents.
That's a huge beat, nearly 16% growth, and adjusted EBITDA hit $312 million, up 11%.
And the market absolutely loved it. We saw shares pop, about $6 at the close?
$6.09. That's a 3.39% jump, trading around 185.62. But look at the volume. That tells the real story.
It wasn't quality trading.
No, the volume was massive. About 7.5 million shares traded. That is roughly 5 times the normal daily average.
So this wasn't just retail investors taking a flyer on an earnings pop.
No, this is institutional accumulation. This is the big money pension funds, mutual funds stepping in. They aren't just being polite. They are buying the durability of these margins.
And if you want to know why, you have to look at the holy grail metric of LTL trucking.
The operating ratio, or OR.
The OR. We talk about this a lot on the show, but for the listeners who don't spend their lives inside trucking spreadsheets, let's clarify. This is essentially the inverse of margin, right?
Exactly. It's how much it costs to generate a dollar of revenue. So unlike most metrics, lower is better. It's your cost per dollar.
So if your OR is 90, it costs you 90 cents to make a dollar.
Precisely. And for North American LTL, XPO posted an adjusted operating ratio of 84.4%.
84.4. Contextualize that for us.
Right.
Is that good, great, or world-class?
It is excellent. That is a 180 basis point improvement year over year. They became nearly 2% more efficient in a single year.
Wow.
But here's the kicker, and this is what makes it a self-help story. They improved margins significantly, while daily shipments were actually down 1.6% and tonnage was down 4.5%.
Okay, hold on. We need to unpack this because that defies basic manufacturing logic.
It does.
Usually, if you sell less stuff, or in this case, haul less stuff, you make less money because you have fixed costs. You have terminals, trucks, insurance. Those bills come due whether the truck is full or half empty.
Right.
How do you improve margins by almost 200 basis points when your tonnage is down 4.5%? That math shouldn't work.
That is the multi-million-dollar question. And the answer lies in the difference between self-help and macro-help. XPO isn't waiting for the economy to get better.
They're fixing the house from the inside.
They are, and it starts with yield.
Yield, which is basically pricing, right?
Pricing, but smarter pricing. Yield excluding fuel was up 5.2%. So yes, they are charging more. But it's not just a blanket price hike where they annoy all their customers.
Right, and drive them away.
No, they are actively swapping out low-margin freight for better freight. It's a mix shift.
So they're effectively firing the bad customers.
In a way, yes, or just finding better ones to replace the churn. The specific detail that stood out to me in the call was the relentless focus on local accounts. This is the secret sauce.
Right. They mentioned this specifically. They added, 10,000 net new local customers in 2025?
10,000. Now think about the difference between a local customer and a national account. A national account is your Amazon, your Walmart, your Home Depot.
The big guys.
When they walk into the room to negotiate shipping rates, they bring a sledgehammer. They have all the leverage. They say, we have 1 million pallets. Give us a discount or we walk.
And margins on that freight are razor thin.
Exactly. It's volume, but it's empty calories volume sometimes. But a local customer, that's a mid-sized machine shop in Ohio. That's a regional distributor of pool supplies.
They don't have a massive logistics department.
No, they ship maybe 10 pallets a week. They need reliability, they need the truck to show up on time, and they don't have the leverage to demand rock-bottom prices.
So they pay premium rates for the same space on the truck.
Significantly better rates. The yield per hundredweight is much higher. And XPO said, local is now 25% of their entire book of business.
And their target is 30%.
Right. So every time they swap a giant low-margin national shipment for a local one, the yield goes up, even if the weight is the same. It's arbitrage within their own truck.
That makes perfect sense. It's quality over quantity. And they also mentioned premium services growing to 12% of revenue. What exactly counts as premium in trucking?
It's all the value-add stuff. Think about retail store rollouts, where a brand needs all the shelving delivered at exactly 2 a.m.
Oh, right. Precision.
Or specialized handling for fragile goods. Or grocery consolidation. It's anything that requires more than just bumping a dock and dropping a pallet. It adds complexity, and complexity commands a price.
Okay, so that explains the revenue side. They're getting paid more for what they move. But you can't get an 84.4% OR just by raising prices. You have to cut costs too, right?
Absolutely. You can't price your way to prosperity if your operations are sloppy. And this brings us to the second pillar of the self-help strategy: purchased transportation.
This is one of those industry terms that sounds innocent but hides a lot of sin. Break it down for us.
Purchased transportation is basically outsourcing. When an LTL carrier runs out of drivers or trucks, they pay another trucking company, usually a truckload carrier, to move the goods for them.
So they're subletting the work.
Exactly. And obviously, when you pay someone else to do the work, you are splitting the profit. XPO drove their outsourced miles down to a historic low of 5.1%.
5.1%. That seems incredibly low for a network this size.
It is world-class. Think of it this way. It's the difference between cooking dinner at home versus ordering Uber Eats.
Huh, I like that analogy.
When you cook at home, insourcing the line haul, you buy the groceries, you do the work, and you keep the money. When you order out, you pay a massive premium for convenience. XPO is cooking at home every night.
So by doing the driving themselves, they capture the full margin.
And it does something else too, which is arguably more important for the long-term investors. It insulates them. If the broader economy heats up and truckload rates spike, XPO doesn't care as much.
Because they aren't renting capacity from those guys.
Exactly. They own it. They have isolated their P&L from external inflation in the spot market. That is a structural change. That's not just a lucky quarter. That's a different way of operating.
It turns them into a fortress. Now, speaking of structural changes, we have to pivot to technology. Because usually, when trucking companies start talking about AI, I roll my eyes a little bit.
Me too. It feels like buzzwords.
Oh, we have an AI-enabled supply chain. Sure you do. But XPO actually put a price tag on it this quarter.
They did, and this was refreshing. Usually management teams just wave their hand and say efficiencies. But here, they explicitly quantified the value in dollars and cents.
Walk us through the unit economics of their tech, because I think this is where people underestimate the complexity of moving boxes.
No, it's an optimization nightmare. So start with pickup and delivery, or P&D. This is the hardest math problem in logistics. You have a driver in a city with 15 stops, traffic, delivery windows.
Millions of possible route combinations.
Exactly. And if he takes a left turn instead of a right turn, he sits in traffic for 20 minutes and misses a pickup. And that 20 minutes costs money.
A lot of money, I'd imagine.
Well, management said that for every 1 point improvement in P&D efficiency, just getting that driver 1% better, it adds $9 million in annual profit.
$9 million for 1 point. That scales up fast.
Then look at the dock. This is loading and unloading essentially giant games of 3D Tetris. Every point of dock productivity is worth $4 million.
Okay.
And then line haul, the long distance driving between cities, every point of efficiency there is worth $16 million.
So these aren't rounding errors. You can squeeze out a few points of efficiency across the board. You are talking about tens of millions of dollars falling straight to the bottom line.
Precisely. And this is where the proprietary tech comes in. They just finished a pilot of their AI route optimization software.
Oh.
And importantly, it's not off-the-shelf stuff. They built this in-house.
And they're rolling it out to half their service centers in Q1.
Right. So wait, the results we just saw, this beat, this 84.4 OR, that didn't even fully include this new tech yet.
No, it was just a pilot. That's why the guidance is so confident. They don't necessarily need more boxes on the truck to make money. They just need the AI to tell the driver how to drive the route better.
It's fascinating because it turns a trucking company into a math problem. If you solve the math, you make the money.
And XPO has been very aggressive about solving the math.
All right, let's shift gears to the strategy that I think scares some people but excites others, the contrarian bet.
The big one.
Because usually in a freight recession, and let's be clear, we have been in one for a while, companies cut back. They sell terminals, they lay off drivers, they shrink to survive. XPO did the opposite.
They went on a shopping spree.
They have greater than 30% excess door capacity. They built this, quote, ahead of the upcycle. So my question to you is this dead money? Is this just empty real estate costing them property tax? Or is this a genius move?
It is what we call operating leverage optionality.
That sounds expensive.
It sounds fancy, but the logic is brutal and simple. Look at the competition. The industry has lost massive capacity. Remember Yellow? The giant bankruptcy a couple of years ago. A huge player.
Huge. That took thousands of trucks off the road. And private carriers have been shrinking because they don't have the balance sheet to sustain this long downturn.
So the overall pie of available trucks is smaller.
Much smaller. But XPO kept building. Their fleet is young average tractor age is 3.7 years. They have these empty doors. So here is the logic. When the ISM manufacturing index finally turns...
And we are seeing some signs.
We are. When demand snaps back, what happens?
Shippers panic. They need trucks immediately.
Right. And most carriers will have to say, sorry, we need to hire drivers, we need to lease trucks, we need to find a terminal. That takes months. XPO just opens the door.
They can say yes to volume immediately without spending a dime on new real estate.
It's already there. And because the fixed cost, the mortgage on the terminal, the lights, the taxes is already covered by current revenue, the profit on that new freight is massive.
And what do they say the incremental margins would be?
Greater than 40%.
Wait, explain that for the listeners. Incremental margins. That's a key term here.
It means for every new dollar of revenue that comes in during the recovery, 40 cents of it goes straight to operating profit.
That is an incredibly high flow-through rate.
It is. Usually in a capital-intensive business, you're happy with 15 or 20 cents. But here, the cost structure is already paid for. You are just adding fuel and driver pay. The terminal is paid for, the tech is paid for.
So that 30% excess capacity is basically a coiled spring.
That is the perfect metaphor. It is a coiled spring. The tighter you compress it during the downturn, the harder it snaps back when the pressure releases.
Let's shift to the macro and the guidance, because we are sitting here in early 2026. What are they seeing right now? Because they gave us some data on January.
They did. January tonnage was flat year over year.
Now, to the average person, flat sounds boring. Doesn't sound like a growth story.
In context, flat is incredibly bullish. Because normally, January drops off significantly from December due to seasonality. People stop shipping after the holidays.
So flat means it outperformed.
Massively. And remember, there was a winter storm in January that they estimated knocked 3 percentage points off the total.
So without the storm, they would have been up.
Likely up 3%. That is a signal. It's a pulse.
And looking ahead to the full year of 2026.
Management guided to another 100 to 150 basis points of operating ratio improvement.
And what's the caveat? because there's always a caveat.
That is the best part. They said they can achieve that without a macro recovery.
So if the economy stays bad, they improve margin by 150 basis points if the economy gets good.
Then you layer that 40% incremental margin on top of it. That's the bull case. They win if it stays flat. They win big if it goes up.
Okay, so let's summarize the board here. We have a company that is optimizing its way through a downturn, sitting on a mountain of spare capacity and telling us they will make more money next year, even if the economy does nothing.
That sums it up. It's a defensive play with offensive upside.
Well, that sounds like a setup for our favorite segment.
I think I know where this is going.
It is time for This Is Not Financial Advice.
My favorite, legal liability.
Exactly. Look, listeners, we're just voices in your headphones. We are not your financial advisors. Do not do this. But if you were a hedge fund analyst pitching to an investment committee with a high risk tolerance and too much caffeine, what is the trade?
I'm calling this the empty door gamma squeeze.
The empty door gamma squeeze. It sounds like a wrestling move. I love it. What is the thesis?
The thesis is that the market is currently pricing XPO based on recessionary volumes. It sees the flat tonnage and says, okay, they are efficient, cool story. It is completely ignoring the coiled spring.
It's pricing in the now, not the what if.
Right. But the setup is this. The private carriers are tapped out. The moment the ISM Manufacturing Index crosses 55 into clear expansion territory, and maybe the Fed cuts rates one more time, freight won't just grow, it will explode.
And XPO is the only one with the doors open.
Yeah. Exactly. So here's the trade. You go long OTM out of the money calls on XPO. You want them dated for late 2026, targeting the Q3 peak shipping season.
You're swinging for the fences here.
But here is the twist. You pair this with a short on the capacity-constrained carriers. Now, you can't short private companies, so you use a proxy. You short a generic transport ETF that is heavy on old-school rail or companies that cannot pivot fast.
So you are long agility and short rigidity.
Precisely. Why is it outrageous? Because you are betting on a massive industrial boom when everyone else is scared of a recession.
And why is it plausible?
Because if XPO fills those empty 30% doors with zero CapEx spend, the doors are already built, the incremental margin isn't 40%. It feels like 100%.
The earnings per share won't just go up linearly.
They will hockey stick. The stock doesn't just go up, it teleports. You get a gamma squeeze as dealers have to hedge those calls you bought.
It teleports. I like that visual. Again, do not do this. But if you do, send us a screenshot.
We don't. We'll get sued.
Okay, let's bring it back to reality to wrap this up. We saw a clean beat from XPO.
Very clean.
They are proving they can hike margins in a down market using tech, using mix like those local accounts, and using that premium service layer. They've built a better mousetrap.
And the bullish thesis really rests on that operating leverage kicking in. The market rewarded margin durability today. The stock is up because they proved the floor is high.
The floor is high. That's the safety net.
Right. But the ceiling, the macro recovery, the filling of those empty doors, that hasn't even been hit yet. That is the upside optionality.
So basically, XPO built a Ferrari, and they're driving it in a school zone right now. They're idling efficiently, saving gas, but they are just waiting for the speed limit to change.
That is a fantastic way to put it. The engine is idling, but it is a very efficient idle. And the moment the light turns green, they're the only ones with gas in the tank.
Well, there you have it. XPO delivering the goods, literally and figuratively. That's all for this deep dive into the Q4 2025 earnings.
It was a pleasure unpacking it.
Thanks for listening, everyone. And remember, keep watching the tickers.